Okay, good evening everybody, and welcome to another webinar on a certainly cold and windy and rainy Cape Townian night. Hopefully for those of you scattered around the country and certainly throughout Africa, you're having a better evening than what we are doing right down here over this evening. Okay, so firstly it's great to see a full house here tonight. Certainly it seems like the appetite is there to find out more about technical analysis. So welcome to those of you who are tuning in for the first time. Just a little bit of background on myself. I've been in the financial markets for about 8 or so years. Got most of my experience over in London with the big banks there, and I basically have been working at the brokers in South Africa since about 2008 when I returned. Okay, so basically what I asked last week was, what are the sort of indicators people wanted to chat about tonight, and I also want to structure it in such a way as to make it sort of like a sort of a novice to intermediary kind of experience for everyone, so that they can all kind of pick it up. And as we go along, we'll delve a lot more into sort of advanced techniques and more expert techniques as well. All right, so what I'm going to be talking about tonight is the start of it all, is support and resistance. So what we're looking at there is trend lines, channels, trading lines. We're going to use that in conjunction with Japanese candlesticks and Fibonacci levels as well. So we're going to have a brief look at what Japanese candlesticks are, some the basic candlestick patterns. From a Fibonacci level point of view, what defines a Fibonacci level, and how to combine Fibs with other indicators. I think you'll get a lot of use out of that. Another technique of how to place stop losses with Fibonacci levels as well. So if you utilize these techniques in conjunction with what I talked about last week, you should be able to start to structure together a decent sort of technique that suits your trading strategy. All right, so briefly, we're just going to talk about support and resistance. What we have here is, when a market moves up and then pulls back, the highest point reached before pulled back is called resistance. So it's almost like a price ceiling at which, the price gets pushed to, and then all the bears in the market say, hang on, no, we don't think it's worth more than this, and then they tend to pull it back. As the market continues up again, the lowest point reached before it starts back is called support. Okay, and that's what we would call almost like a price floor, if you want to call it that. In this way, resistance and support are continually formed as the market oscillates over time. And of course, the reverse is true for the downtrend as well. So a picture's worth 1,000 words. I don't have to talk too much about it. You can see from the sort of the zigzag pattern at the top there what I mean by resistance and support. Now, one thing to remember is that support and resistance levels are not exact numbers. All right, so often what you'll see, especially if you're using candlestick charts, is that these levels will get tested, and what you'll see is the actual price might dip through these actual levels and then retrace back up to that level. So as long as we know that that support or resistance level is getting hit, we then tend to realize that it is significant. Important here is when plotting support and resistance, you don't want the reflexes of the market, so those knee-jerk reactions. You want to kind of steer away from those. An easy way to find those sort of points is to maybe utilize a line chart like how I've used it here. And looking at the line chart, you want to plot your support and resistance lines around areas where you can see the price forming several peaks or valleys. Okay, so if we have a look at our support zones here in green, we can see that these levels get hit quite a few times. So we know that those horizontal levels are significant. Okay, and then conversely on the upside here we have our resistance zones. This would probably be deemed as more of a major kind of resistance level because we see that hit quite a lot. And this we would deem as a minor resistance level. And then conversely down here we would have a minor support zone. So that, like it's a level that has been tested but not as significantly as these ones in the middle here. Okay, just one basic thing to remember here is that when a level of resistance gets broken, that resistance could then potentially become support, and vice versa. If the support line gets broken, we will then start to see that level being called resistance. And then, as I've alluded to earlier, The more often a price tests a level of resistance or support without breaking it, the stronger the area of resistance or support is. So that's what I always like to use as an indication of price action. How do people react to these sorts of levels? And it really is quite easy to see. So I just want to make sure that my session is going along okay. And basically we just want to make sure that those levels are significantly holding at those prices. Okay, when a support or resistance level breaks, the strength of the follow-through move depends on how strongly the broken support or resistance has been holding. Okay, so if we have a look at this quick little picture that I've got down here at the bottom, what we have here is what I've called minor resistance, minor support, and all these various different things. Here we go at the top here, major resistance has been tested many, many times. So that's a significant level for me. Less so down here, for instance, where we have our minor support. However, though, quite honestly, if I had to draw a trend line in here from the strong support through the minor to minor support there once again, that's actually quite a reasonable trend line if I just have a look at that for the first time here. All right, so basically we want to just kind of be aware of these prices and how often they get hit. Okay, so something that I want to talk about here is channels, okay? And channels represent potential areas of support or resistance, okay? To create an up channel or ascending channel, simply draw a parallel line at the same angle as an uptrend line, and then move that line to position where it touches the most recent peak. Conversely, to create a down channel, we'll do pretty much the opposite here. We'll draw a parallel line at the same angle as the downtrend line, and move that to the line to position where it touches the most recent value. Okay, so the point's down at the bottom here. Now I've got a screenshot and on the next slide here of what these things will look like. But channels should be added when inputting your trend lines. When prices hit the bottom trend line, this may be used as a buying area. All right, and I'm going to show you on that chart what I mean by that. And then conversely, when prices hit the upper trend line, we'll use this as a selling area. All right, so let's have a look and see what I mean by that. All right, so on the next slide here, we have three different types of channels. We have an ascending channel, which I've done in blue, descending channel, which are in red, and then horizontal channel, which are deemed to be ranging. All right, so with your ascending channel, what you'll see happening is here, we'll get higher highs being formed and higher lows. All right, a descending channel, we get lower highs and lower lows, and then a horizontal channel, we basically have a trading range where it's just kind of trending in a sideways movement. All right. So if we have a look here on the up channel here, if we were looking to enter into a particular trade here, well, first we want to make sure that these channels are getting hit, and I would be looking to make a buy as soon as this bottom channel gets hit. Conversely, on the down channel, I'd be looking to sell whenever it hits this top level here. All right. As we move up through this another up channel here, we basically will hit it. We're looking to hit the trade when we see this bottom channel being hit, and then once again on the down channel when that top line gets hit. All right, and we want to, and as you kind of go along, you'll start to notice if you use that in conjunction with something like candlesticks, then you can definitely look for the confirmations of a potential buy or sell kicking off these different channel levels. All right, so some important things to remember about channel lines. When constructing a channel, both trend lines must be parallel to each other. Okay, so I've drawn a quick little example down at the bottom there. On the left-hand side, this is the correct way to do it. We see this downtrend gets hit several times. We will draw a parallel line just completely parallel to that. On the right-hand side there, we see it's just completely drawn incorrectly in terms of having our trend line breaking through at completely wrong levels. Okay, generally the bottom of the channel is considered the buy zone, while the top of the channel is considered the sell zone. Don't ever force the price to the channels that you want to draw. Okay, so you basically want to make sure these things are parallel, and also just kind of goes back to what I'm saying in these pictures here. Just make sure that they are completely straight to each other. A channel boundary that is sloping at one angle while corresponding channel boundary is sloping at another is not correct and could lead to bad trades. All right, so if we have a look on the right-hand side there, if we had decided to do these sort of trades, a buy off these sort of things, we could certainly have ended up in a spot of bother. if the market retraced like it has done here. All right, so what I'm going to talk about here is actually trading these lines, and one of the techniques we're going to talk about is the bounce. Now, many retail traders make the error of setting their orders directly on support and resistance levels. Okay, and this very often can lead to a few errors. This may work out, but quite honestly, this type of trading assumes that a support or resistance level will hold without price actually getting there yet. Trade support and resistance level right after the bounce. Okay, so what I mean by that is on the left-hand side, if we have a look here, we would basically wait for the bounce off the support line, probably a couple of pips, maybe 10, 15 pips off that support line, dependent on what time frame you're working on, and we would then in turn have our stop loss level about sort of 10, 15 pips below the support line. Okay, and then conversely, trend line resistance, we would wait for this bounce up to this trend line, wait for a little bit of a bounce below, and then we would enter. And on the converse side, we would have our stop loss level just a little bit above the actual trend line itself. Okay, when playing the bounce, we want to increase the probability of success by finding confirmation that the support or resistance will hold. Now, wait for it to bounce before entering, and so often you'll see this happening. Now, by doing this, to avoid those moments when price moves fast and break through support and resistance levels. And very often that can happen. Now, as I've sort of said there, from experience, catching a falling knife can get really bloody. So, very often people will see this thing hit the support line and think, okay, well, fantastic, let's go for a buy. And all of a sudden, the price smashes through the support, and all of a sudden we are in a losing trade. All right, so wait a little bit. Be patient to see how how traders react off these prices as it hits these trend lines. All right, so in the perfect world, support and resistance levels would hold forever, but it's not a perfect world, quite honestly. Basically in a perfect trading world, we could just jump in and out whenever price hits those major support and resistance levels. But the fact is, the levels do break often. So just to reiterate what I said, it's not enough to just play bounces. You should also know what to do whenever support and resistance levels give way. And there's two ways to actually do this. There's the aggressive way and the conservative way, and I'm basically going to start off with the aggressive way. All right, and the simplest way to play breakouts is to buy or sell whenever prices pass convincingly through a support or resistance zone. Now you'll see I've put convincingly in bold there because we only want to enter when price passes through a significant support or resistance level with ease. Okay, so you get a basic idea here of what I'm saying on the left-hand side. The price breaks through support, I would have my entry level below and stop loss above. But just on the right-hand side, this gives you a good idea of what I'm talking about. So we have a horizontal resistance level here, and what we then see is a big, strong push through that price level. It kind of consolidates a little bit, and that's what I'm looking for. If I'm going to carry on trading this on a long or a bullish trade, I would look to enter at that level over there. I don't want to see it come up there, and by the end of the time frame that this candle completes, it's now come back down to test that horizontal level, because then we know that the resistance is still intact, and buy trade is just not a viable option right now. So I want to see that big, strong push through there and make sure that the candle is complete before I make my decision. All right, so the conservative way, okay, and just imagine this hypothetical situation. You decided to go long the euro dollar, hoping it will rise after bouncing from a support level. Soon after, however, support breaks and you're now holding on to a long losing position with your account balance slowly falling. All right, two options here. Do you accept defeat and liquidate your position, or do you hold on to your trade and hope prices rise up again? All right, if your choice is the second one, then you'll easily understand this type of trading method. All right, closing your euro dollar long trade at or near break even means you will have to short the euro dollar by the same amount. All right, so if I've bought the euro dollar at 2 lots, then I basically have to sell 2 lots to close out that trade. Now, basically, if enough selling and liquidation of losing positions happen at the broken support level, price will reverse and start to fall again. This is the main reason why broken support levels become resistance whenever they break. All right, so just think about that for a second. Okay, so let me just say that again. If enough selling and liquidation of losing positions happen at the broken support level, price will reverse and start falling again. All right, and that's why support becomes resistance, and conversely, resistance becomes support. Okay, so the key factor is here, be patient. Now, instead of entering right on the break, you wait for the price to make a pullback to the broken support or resistance level and enter after the price bounces. All right, so what we see happening down here is we see a break through the support level. All right, the price kind of consolidates here, comes back up to retest that horizontal support level, and then we see it kind of break into the downside. Now we know that this horizontal support level couldn't hold, and we should continue to see this trending on downwards. All right, just something to talk about here on the pullback. You would probably place your stop loss just a little bit above the support level if you're going to short, just in case that particular trade does come back and right itself within that support level. Okay, so I'm going to quickly move through Japanese candlesticks here. You know, candlesticks have been used for any time frame. Quite honestly, my recommendation is to always use them, because there's just a wealth of information that they give you for any particular time frame, and they basically describe the price action during that time frame. So what you'll see happening here is, you know, it'll detail what price it opened at, it closed at, what the lows were for that time period, what the highs were for the time period. And after a while, you know, these will obviously develop formations. And from that, you can then start to distinguish what the market is thinking in relation to a particular price level itself. Okay, so candlesticks are formed using open, high, close of the chosen time period, as I've already said. If the close is above the open, then a hollow candlestick usually displays as white is drawn. All right, if the close is below the open, then a filled candlestick is displayed, or black. All right, so that is just something worth noting. The hollow or filled section of the candlestick is called the real body, or the actual body of the candle itself. You know, the thin lines poking above and below the body display the high and low range are called shadows. All right, so if I go back to the previous slide here, you'll see what I mean by that. Okay, so there we have the actual bodies in black and white, and then we have the sort of the upper shadows and the lower shadows below it. All right, so this is saying, right, if I have a look at this one on the left-hand side, we can see that the price was pushed to this particular level and then retraced back down to the body. So that basically means that, you know, the bulls try to push it up a little bit higher than what it really was worth, and the bears basically said, no, hang on, I don't think it's worth that. And they pulled the price back down over that particular time period. And then from that we can start to, you know, obviously come up with ideas of what people are thinking at these various different prices. Okay, so what I'm going to talk about here is a couple of formations. We've got single formations, double formations, and triple formations, all of which are useful in identifying what we should be looking for. And the first two on the left-hand side here, they basically do this similar sort of thing. We have our spinning tops and our dojis. And what these could very often indicate is that there's sort of indecision around a particular price. So what we'll see is that the price has either moved up quite high or quite low over the time period that you allocated. But by the end of that actual trading session, when that particular candlestick gets completed, we'll see basically just a thin-looking line right in the middle, which basically denotes that there's indecision between the bulls and bears. So it's really a 50-50 battle as to who is winning that one. You know, moving on down here, what we have is a white Mariposa, which is it tends to be a bullish formation. So what we'll see is the price will open up down below, and by the time the candle is actually completed, we have had nothing but upward movement. All right, so that tends to denote that we're in a nice bullish move and probably looking to buy thereafter. Conversely, we have the black Mariposa, which is bearish, and in a complete mirror image of the white one. We're looking for a sell basically off the back of that particular formation there. Moving on to the right here, we have our our hammer, which is basically a bullish formation. And what you'll see happening here is sort of a downtrend here. We'll see that this particular price has to move back down. We've ended up with the price retracing up and a white candle, which is fairly important. And then what you should generally tend to see is a movement to the upside thereafter. Conversely, we have a hanging man. And don't you just love these names? They're fantastic. But here we go. We have a hanging man, and there's basically a similar thing, but what we end up having is that the body is full. So what that tends to mean is that we're looking for a downside movement there. The inverted hammer, which is the direct opposite of your hammer here, is we've had this down movement. The bulls have tried to push it to the upside. The bears have said no, but we have still had movement to the upside here. And thereafter, if you have a look, if we use that in conjunction with what we have over here, the white Mariposa, it's a very strong indication that this is going to the upside. Conversely, a shooting star here, which is a bearish formation, which is the opposite of a hanging man, really, where we've seen the price push up high. It hasn't maintained up there. The bears have pulled it back. The body is full, and we then see a reversal to the downside. Okay, in terms of double formations, we have a bullish engulfing candle here. So what we have here is a big white candle overpowering the previous black one. From that we can denote that the bulls are coming into the market quite strongly, and what we should then see is a movement to the upside. Conversely, with the bearish engulfing, same story here, direct opposite. We have a small white candlestick formation followed closely by a very strong black bearish formation. We should see this moving to the downside. Tweezer tops basically denote once again a reversal pattern here, kind of because they look like tweezers. See, basically the price has tried to push back up, it hasn't held, and then we should see a reversal either to the upside or downside. Tweezer bottoms, this is basically a bullish formation, as I've already mentioned. It's converse to the tweezer tops. Okay, triple formations. All right, so here we have a classic morning star. We basically now are just joining up all these various different single formations and putting them into, strapping them along next to each other to come up with, a bigger picture really of how the market is now reacting to these price levels. All right, so what we see here is, even though we have seen a big engulfing pattern on the left-hand side, it gets stopped abruptly by this doji formation here, followed closely by a nice big white bullish candle. And this should illustrate or denote a reversal in the market itself. The evening star is the direct opposite, so that'll be a bearish formation that we're looking for. Basically we'll see that the price hits some kind of resistance level probably. We'll see this doji or spinning top being formed at the top here, and then we should then in turn see a reversal. All right, so 3 white soldiers, I quite like this one. Basically what you'll see is 3 nice big long white candles being formed. That really gives me confidence that the bulls are really in the market, and I'm quite happy to go in and buy. Same story with the 3 black crows. If I see 3 formations coming along like this with 3 big black formations going on there, then I'm quite happy to sell there. Finally, the 3 inside up and 3 inside down, 1 bullish, 1 bearish. Basically, you can see what the formation is going on there. We've had 1 full black formation followed by 2 strong up candles, Japanese candles being formed there, and then conversely on the downside, we had a really big. Actually, well, we have 3 black crows followed quite shortly after that 3 inside down. So really, some good formations there. I am going to send through these cheat sheets to everyone that attended tonight. It's a great way to just refer back to them, have them next to your computer, and just until such time as you look and spot these things and become second nature to you. All right, so I'm just going to move on to Fibonacci levels now, and a lot of you had a lot of questions about what Fibonacci's were last week. just to kind of go through the brief history of it all, Fibonacci levels were created by a chap by the name of Leonardo Fibonacci. He was an Italian mathematician. And the actual ratio itself is derived from this number sequence that we have that basically here. What you're going to have is 0 plus 1 would equal 1, 1 plus 2 equals 3, 2 plus 3 is 5, 3 plus 5, 8, so on and so forth as you go through the number sequence itself. But more importantly, the actual levels that, well, percentage levels that we are able to derive from the sequence are what we care about as traders. All right, so there's the levels that are significant to us, or percentage-wise, are these ones that I've listed here. So the 0.23 level, the 0.38, the 0.50, the 0.61, and 0.76. Those are basically called the golden mean. All right, other important levels for us in extension, if you want to call it that, are sort of your 0.38, 0.61, your 1, your 138 to 161. All right, so how do we use these levels? All right, so firstly, the Fibonacci retracement levels we use as potential support and resistance areas. And because this is such a popular technique, so many traders watch these same levels and place buy and sell orders on them to enter trades or place stops. The support and resistance levels tend to become a self-fulfilling prophecy. Because so many people are using these things and they're all placing their orders around about these levels, that's just human nature. That's just the way that the market works. It's a silly thing, but it's reality, quite honestly. And then the second statement that I have here, like we will use the Fibonacci extension levels as profit-taking levels. So we're looking to enter in at something like the 0.50, and we're looking to take profit at maybe 1.38 or something like that. Again, since so many traders are watching these levels, it becomes a self-fulfilling expectation as well. Okay, so an important thing to remember here is that Fibonacci retracements work best when the market is trending. Okay, we don't really want a sideways movement. We want to see a nice decisive move to the upside or downside. All right, so I would go long or buy on a retracement at a Fibonacci support level when the market is trending upwards. All right, so here we go. I've got my first example here. And basically how you would draw these using your MetaTrader 4 tool is you would basically hold down from your swing low at the bottom, draw it up to your swing high, as you can see what I've done here, and then basically these levels get superimposed onto your chart. All right, and just as I've kind of progressed through the day here, I've noticed now that not only has my price bounced off my 38.2 level, but it's also bounced off my trend line, all right, which has denoted a nice entry point for me here as well. Okay, so if I wanted to go short on a retracement at a Fibonacci resistance level when the market is trending down, all right, and here we go. Once again, I've got my swing high. I would draw my line down to my swing low. All right, once again, my levels get superimposed. So there are all my levels of 100, 61.8, 50, 38.2, 23.6. All right, so and we can see that there's a downtrend as well. This downtrend, if you actually took this, basically this was just a snippet that I took out of the actual chart itself, but this is quite a significant downtrend that I've drawn in here as well. And basically what we're hoping to see is that this price is going to bounce off our horizontal support levels or resistance levels. And this is basically what happens later on this day. As the price has moved on, what we see happening here is, yes, we have a downtrend, and the price tends to retrace back to some of these levels here. And we can see that it had a little bit of interest around the 23.6, but really where it ran out of gas was at my 50% level. Not only did it kick off that level there, but it also kicked off my trend line as well. So that is where I'm looking to enter. If I wanted to include something like Japanese candlestick formations as well, all these little Japanese candlesticks that are being formed here, these little spinning tops, that also denotes a particular reversal is imminent. So this trend was basically coming to an end. It was basically exhausting itself. And so this is basically where I would be looking to short. All right. For those of you who had missed out on this particular entry point, you can still have shorted here as it's smashed through this particular uptrend here as well. Okay, so what I'm going to talk about here is combining Fibs levels with support and resistance. One of the best ways to use the Fibonacci tool is to spot potential support and resistance levels and see if they line up with Fibonacci retracement levels. If Fib levels are already support and resistance levels, and you combine them with other price areas that a lot of other traders are watching, then the chances of price bouncing from those areas is a lot higher. Okay, so here we have our first example here, and let me see if I can get up my little pointy tool here. Okay, so we basically identified our swing low, and we're going to draw this all the way up through to our swing high. There's our Fibonacci retracements. As you can see, our 100, 61, 50, 38.2, 23.6 all been formed. All right. What we're also looking for here is any resistance or support lines as well. All right, and basically what we do see here is that we do have resistance which turns to support and has been tested. All right, so what we have here later on this day, that was my initial position that we had drawn our Fibonacci lines into. We see it basically coming to a halt above there. We see it retrace back down to this 38.2, and this 38.2 level is fairly significant because we can see that this gets hit quite a lot. We see a lot of exhaustion candlesticks around this, and I'm going to talk about exhaustion candlesticks just now. But we see that the price tests this level and fails to really break through that. All right, and then finally what we eventually do see happening is there's basically our resistance level turns to support. And finally what we do see happening eventually is we now see our basic move from 38.2 to the upside. So it's the continuation of the upward trend. The horizontal support line has held, and it's held on a really nice level along with the Fibonacci. So we've got three things that we've used in conjunction there. We've used our trend line, we've used our Fibonacci retracements, and we've used our support line. All three things used in conjunction have given us a really, really nice buy trade. Okay, so Fibs now in the downtrend. All right, so what I've drawn there, I've drawn a really nice sort of downtrend here, which is quite significant. This is on platinum. It's on a 1 hour chart. So we can see our descending trend line there. I've inputted my Fibonacci's from the swing high down to the swing lows. And we can see that this trend line itself is fairly significant. That has been tested quite a few times already. All right, and then later on that day, what we see happening here is these levels do come down, and what we saw earlier was the price was round about here. It came back to test out the 23.6 level. Not only did it test that, but it also tested our resistance level, which is this turquoise line that I've drawn, but it's also tested our descending trend line as well. So once again, I've used three things to identify my entry points, okay? I've also got a really nice indication of a imminent reversal looking at my Japanese candlesticks. So that is now four things that I've used in conjunction to say, right, well, I think that this downward trend is now ready to continue on its downward momentum. So I'd enter at that particular level, and as we can see here, luckily enough, it's moved in our favor. Okay, so a couple of tips to remember there. Now, previous support and resistance levels would be good areas to buy or sell because other traders will also be eyeing these levels. So I'll always leave my horizontal support and resistance levels in because, as I said in previous webinars, these levels are, the markets are cyclical, and these levels do tend to repeat themselves. Now, since we know that a lot of traders also use the Fibonacci tool, they may be looking to jump in on these Fib levels themselves, so that will present opportunity for us. With traders looking at the same support and resistance levels, there's a good chance that there are several orders at those price levels. Now, while there's no guarantee that price will bounce from those levels, at least you can be more confident about your trade. it's all about strength in numbers. We want to try trade with the pack. We want to try, follow the herd a little bit. And remember that trading is all about probabilities. If you stick to those higher probability trades, then there's a better chance of coming out ahead in the long run. All right, so I want to try put as much information in my corner as possible. I want to make sure that I get reap the rewards of a high probability trade rather than a high risk trade. Okay, so now I'm going to talk about combining fibs with trend lines. Another good tool to combine with Fibonacci tool is trend line analysis. Fibonacci levels, as I've already talked about, is really good when the market is trending. Okay, so whenever a pair is in a downtrend or uptrend, traders use Fibonacci to retracement levels as a way to get in on the trend. All right, so if we've got an uptrend, we wait for a bit of a retracement to a better level before buying. Conversely, on the downtrend, we wait for it to retrace upwards before then continuing on the downward momentum trade. All right, so line up your fib levels with your trend lines, as I said there. And if you see a trend developing, you should be looking for ways to go long to give you a better chance of a profitable trade. All right, use the Fibonacci tool to help you find potential entry points. Okay, so here we have fib levels in an uptrend here. So we can see down the bottom in red we have our uptrend. And what I've gone and done is this is now on a gold chart and on a gold daily chart. Still when gold was sitting up in the 1500s, as you can see, the last week gold's been fairly torrid. But nevertheless, we have our Fibonacci levels drawn from our swing lows through to our swing highs. And what we're hoping for here is for this particular price to retrace down to our trend line, and using that in conjunction with our Fibonacci's, we want to see that kick off that trend line, kick off our Fibonacci level before continuing in an uptrend. All right, and basically what we see happening later on, and this is just an extension, what I've drawn here is this is our trend line continuing in an upward direction. We see the gold price coming back down and testing these levels, certainly at various different stages, but where it's been tested the most is at the 61.8 level. All right, so we use that in conjunction with our trend line. We can also see from these candlesticks here that the price was tested at the trend line, it battled to hold, and eventually what we tend to see happening is these exhaustion candles are just too much for it to handle, and then we see it trading through to the upside. All right, so fib levels in a downward trend. So here I've got the dollar Japanese yen on an hour chart. So you can see I've used them on different instruments at different time frames. You can use them for a multitude of different things. All right, so we have our downtrend here. We've identified our highs and lows at which we want to enter. And what I'm hoping for here is for this thing to smack off my downward trend line in conjunction with my Fibonacci's as well. And that's pretty much what we see happening here. What we see happening is the price does retrace to 38.2. It is this level by the time it actually hits my trend line, it is already significant because not only is it bouncing off the 38.2, but that is now my resistance level, which conversely used to be my support level. So now I'm manufacturing a plan here. I've got my downtrend here going on. I've got my horizontal resistance level. I've used that in conjunction with my Fibonacci level of 38.2. And not only that, but I also have a great candlestick formation there indicating that there is an imminent reversal. And that is exactly what we see happening to the downside. And that's basically where we would have hit another sort of a sell trade to the downside. Okay, so you can already see that I've been talking about combining fibs with candlesticks. And that's, as it already shows, I mean, a picture's worth 1,000 words. It's just great to see these things working well in conjunction with each other because they do. If you can tell when buying or selling pressure is exhausted, it can give you a clue of when price may continue trending. So I've taken two quick little examples here. I'm going to delve into it a bit more just now. But I've taken one from the Dow Jones hour chart. I've got one from the pound dollar hour chart as well. And what we see is on the Dow Jones, we've got our downtrend, basically our Fibonacci levels inputted here already. We've seen at the 50% level, we see the price challenging that level there. And eventually what we then see is a nice spinning top or doji saying, right, okay, well, we've had enough of these levels. It's time for a reversal, and we see that big downward movement. Same story here. We have an up movement for the pound dollar. It actually does get a little bit of support around the 38.2, but really what I'm more interested in is how it has reacted around this 50% level, and that is basically sorted out quite nicely with a nice candlestick formation to say, right, well, I think it's time for us to carry on to the upside. Okay, so this is what we're talking about in terms of trend exhaustion. I've taken the euro dollar on a 15-minute chart this time. We have our swing lows down at the bottom. I've drawn up my Fibonacci levels through to my swing high. All right, so from here on in, I'm looking for these levels to become significant. All right. I've also drawn in, this is one of my existing trend lines from previously. And what we see happening here at around about the 61.8 level is we see, even though it might be a bearish candle, it really has exhausted itself. So it tested the trend line, it tested the 61.8, and by the time that candle came through to fruition after 15 minutes, those levels were still intact. Further on, as we carry on, the next candle that then gets created is a great indication of a beautiful doji there, where we see a really big sort of turnaround to the upside. And what we then tend to see is a continuation to the upside as well. So keep an eye out for these things, guys. Just get used to looking out for them. They do mean something, and it gives you an idea. You don't even have to use other indicators. It gives you an idea of how traders are reacting to a certain price. And that's really what we want to see. Okay, so looking for Fibonacci candlesticks. These can signal whether a fib level will hold. If it seems that price is stalling on a fib level, chances are that other traders may have put some orders at those levels as well. This would act as more confirmation that there is indeed support or resistance at that price. Another nice thing about Fibonacci candlesticks is that you don't need to place limit orders at the fib levels. You may have some concerns whether the support or resistance lines will hold, since we are looking at a zone and not necessarily specific levels. Okay, so we're looking at a certain area just in and around at these levels. I mean, look, it's not going to hit it exactly. I mean, it's not an exact science. So very often, these levels, they will get tested and they won't hold. I mean, that is just the nature of it. But we want to use, we want to, as I already said, we want to put our best foot forward and get the biggest possible best picture for us. So we want to use our Fibonacci's in conjunction with candlesticks or various other things. Okay, you can wait for formation right below or above a fib level to give you more confirmation on whether you should put in an order. If a formation does form, you can just enter a trade at market price, since you basically now have more confirmation that level could be holding. Okay, so here I'm going to basically talk about how to place stop losses with fib levels. The first method is to set up your stop just past the next Fibonacci level. All right, so if you're planning to enter at 38.2, which it might be a little bit late or a little bit light here, then you would place your stop beyond the 50% level. All right, so if you felt like the 50% level would hold, then you would put your stop past the 61.8 level, and so on and so forth. So if it's shorted at the 50% level here, as you said, you could place your stop past the 61.8. So I've drawn in a blue little line here, right, to say, right, well, that's pretty much where I would look to put my stop loss if I'm looking at shorting this market to the downside again. Okay, so the reasoning behind this method of setting stops is that you believe that the 50% level would hold as a resistance point. So let's go back there so we can visualize it again. So we saw that the market was at the 50% level. I'm going to put my stop loss level at 61.8, which is just a little bit further up, and I'm looking to short. Okay, so my conviction would be that level is going to hold. All right, the problem with this method of setting stops is that it's entirely dependent on having a perfect entry. All right, and setting a stop loss just past the next Fibonacci retracement level assumes that you are really confident that the support or resistance area will hold. The market might shoot up, hit your stop, and eventually go in the direction. Make sure you limit your losses quickly and let your winners run with the trend. And that's the big mistake that clients make here once again. use this type of stop placement method for short-term intraday trades. All right, so for the intraday traders out there, this works pretty well. I'm not really a fan of using it on the long term. All right, another way to set your stops would be to place them past the recent swing high or swing low. Now, this type of stop loss placement would give your trade more room to breathe and give you a better chance for the market to move in favor of your trade. All right, if the market price were to surpass the swing high or swing low, it may indicate that a reversal of the trend is already in place. This means that your trade idea or setup is already invalidated and that you're too late to jump in. All right, so place your stop at way above the swing high. So there, once again, I've drawn in a blue little line just above your swing high if I was looking to short once again at that 50% level. All right, so at least as I said, rather than having it midway through here, we can have a little bit higher up. Hopefully, it will avoid any kind of knee-jerk reaction that the market might have, and that way at least you will live to fight another day. Okay, so which way is better? The truth is, just like in combining the Fibonacci retracement tool, support and resistance lines, trend lines, or candlesticks to find a better entry, it would be best to use your knowledge of these tools to analyze the current environment to help you pick a good stop loss point. So I don't just like to use Fibonacci's. I use a multitude of different indicators. So you could use all three of these things to come up with a better sort of stop loss pointer. As much as possible, you shouldn't rely solely on Fib levels, as support and resistance levels points as the basis for stop loss placements. Remember, stop loss placement isn't a sure thing. As I've already talked to you about, you want to tilt the odds in your favor by combining different tools. All right, and the key factor is here is you're looking for a better reward to risk ratio. Okay, so a couple of important things to remember. Not all Fib levels are alike, and no technical study is perfect. You must develop the skills to filter out bad trades and improve the odds of finding better trades. Make sure there is a strong trend. All right, that's the key factor for Fibs. We don't want it trading in a sort of sideways movement. We want an upside or downside trend, which is easy to spot. Just what you want to do is watch the price action just before a Fib retracement. Can tell you something about the future as well. All right, so that's what I've been kind of alluding to the whole night. I really want you to watch how prices react around these levels. All right, which Fib level causes the end of a retracement also can give a hint to future price action. Combine the Fibonacci tool with other tools in your Forex toolbox to help give you a high probability of success. All right, and that is it for tonight. I've gone fairly quickly because there was quite a bit of information to get through, but I'm obviously going to be online here. I am going to send this through. I'm going to pop it onto the YouTube channel as well. But please be sure to go refer back to it whenever you need be. Once again, thanks everyone for joining tonight. What I am going to be talking about next week as well is actually how to look at trading foreign exchange itself. And so I'm going to break it up a little bit. So I'm going to, 1 week I'm going to talk about technical analysis. The next week I'm going to talk about just sort of the fundamental aspects of certain different trading instruments. So further on the line I'm going to be talking about gold, trading oil, indices, the actual JSC itself. So basically I need your feedback from you as well. So for those of you who do stay online, please also complete the survey that we send out. I want to hear about what you want to hear about. Right, I've got a question here from Tender. What is the best time frame to trade? This is really an open-ended one, just simply because it really does depend on the type of trader you are. Are you an intraday trader? Are you a week trader? Are you a day trader? Are you a long-term trader? And then from there, you would like to decipher what time frame is best. You know, if I'm an intraday trader, then I want to look at the shorter time frames rather than the long-term ones. I mean, I will still look at the long-term ones just to ascertain what the overall trend line is. But really, that Tender is really up to you as an individual to just decipher what you're looking to achieve with your trade and your portfolio. Got a great question here from Edward. How do I approach the technical data we receive? How do I incorporate it into my trades? Edward, I actually spent this afternoon completing a webinar which I'm looking to record very shortly, which I will be putting onto the YouTube channel. It is a wealth of knowledge that you guys receive on a daily basis. We basically do all the homework for you in terms of identifying your pivot point and all that sort of thing, which is on the technical data. For those of you who have premium accounts, you would have access to a greater service in the way of Trading Central, where not only would you receive 2 emails daily, but rather you would have access to that service all day, where you're getting current updates as you go through it. So for those of you who are thinking about converting to premium accounts, please give that some thought, as there is a wealth of knowledge at your fingertips there. Next question. What is the best strategy that I can use as I don't seem to be doing too well in my trading? Number one, you've got to obviously take a look at this, and I would get a conversation with my account manager. Just sit down and take a look at this and say, right, well, why am I losing on all these trades? Is it because my positions are too big? Am I not putting in the correct stop losses and that kind of a thing? There is no holy grail in terms of a right or wrong trading technique, quite honestly. It's really what works best for you. Okay, so that's what I say. I mean, start off by ascertaining what you want to achieve with your money. What do you want to make over the course of the year, and then break it down that way. And then once you've got the money management and risk management of your portfolio sorted out, then you can start looking at, right, well, what is the technique that I want to use to actually get my 10,000 Rand a day, or 1,000 Rand a day, or my 50 Rand a day, whatever you're looking to achieve. It's all relative to the size portfolio that you're trading. What I've talked about tonight, just using these 4 things in conjunction, using candlestick formations, using Fibonacci retracement, support and resistance, trend lines. You could not go and do anything else. Just use these things alone, and it would be totally fine. For those of you who aren't used to the terminology that I'm talking about, if you go onto our website itself, under research and education, there's a bunch of stuff there just with detailing all these various different indicators and whatnot. Certainly to make use of these webinars that I'm hosting tonight, you really need to do your homework as well. Morena, just a question I'm not quite following. How long will you stay in a 15-minute trade? Can you just elaborate on what you mean by that? Okay, I've got a question here from Tendai. If I want to make 5,000 Rand a day, what account size do I need? Tendai, quite honestly, that's sort of that is attainable really with maybe a 50,000 to 100,000 portfolio. I mean that really can be attainable with those kind of things, but once again it boils down to your risk metrics. Edward, I've got a question there from Edward. How do I place a pending order? I tried today to straddle announcements today with no success. It can be tough around news announcements to actually get the price of what you want. So presumably what you want to do is put in pending orders before the data comes out to execute at certain prices. Basically, if you're using Trader24, you would simply right-click on the entity that you're looking to trade, place an order, and what you're looking for is pending order as opposed to instant execution. And you can obviously input the prices of what you want to enter. But bear in mind, when big news comes out and you see the market really shifting around, you'll get something called slippage, which basically means by the time you actually are looking to be filled at a price, that price has actually moved on a little bit. So instead of getting, for the sake of round numbers, instead of getting filled at a price of 100, if you're looking to go long, you might get filled at 108 or something like that. So really, if you're looking to trade the news as a news straddle, as you mentioned there, certainly get your head around putting in those pending orders. I've got a question from Zizi. When looking on the minutes and hours tab, which one is best to consider when placing a trade? Once again, depends on what sort of trader you are, how many points or how much money are you looking to make per trade. Now, I always start off by looking at the longer-term time frames to ascertain what the longer-term trend is. Is it an uptrend or downtrend? From that point, I can then say, right, well, if I scale down to a half-an-hour chart or a 15-minute chart or 5-minute chart, in the back of my mind, I know on the longer-term time frame, I might know that it is an uptrend. I want to try trade with the trend if I can. So I'm only drilling down to the shorter-term time frames to look for more precise entry points. That's the only reason why I'm going down there. For those of you who haven't attended these things before, this does get recorded and it does get put onto our YouTube channel where you will find various other videos as well. Some of them are on platform trading, some of them are very much like this. Some of them, I've just done one recently on money management and risk management. So please make sure you get onto that channel and check it out. Just got a question from Edward, just once again continuing about news straddles. He says, can I put buy and sell orders before the announcement and use the buy as my stop loss and vice versa? They will be treated as two different trades themselves, Edward. So really what you could have, what you could really have there is the buy trade and the sell trade will execute, and that obviously would form your straddle. I would just be careful here. I would make sure I have fairly tight stop losses if I'm going to utilize that sort of technique. Lorena, just to come back to your question there, do you actually end the trade after 15 minutes or can you hold on a bit longer? Now, for me, it's not a time situation that I'm worried about. It's more about my levels. If I'm using this kind of techniques that I've talked about tonight, I'm looking for levels to get hit rather than just what sort of time frame I'm looking to stay in the trade for. if for instance I do see a trade coming through to an exhaustion point and I don't feel that the price is actually going to get there, well then by all means please close out the trade. But if I do see a really nice strong candle formation being formed, which is heading towards a trend line or Fibonacci line, then I certainly will stay in on the trade and continue and hopefully and it'll end up in a profitable position for me. Just another one from Edward here. He says we need to get into looking at things like workshops. For those of you that are in the Cape Town area, please come into the office. I'm more than happy to meet with you and do these, talk about these sorts of things and steer in the right direction. But also going forward, once I've got all our webinars up and running, and certainly once we've got sort of a nice library of videos, I will be touring through South Africa to all the sort of the big hubs, and we will be conducting seminars as well. So certainly we will keep you posted on when those are looking to take place. But I wouldn't think probably not for the next 2-3 months. As I said, we just need to get this library of education sorted out here. And then certainly I will be going around and just to meet up with you and just broach any questions you might have. Now, certainly once we've got the seminars sorted out in South Africa, we will be branching out through Africa as well. And, if that takes off quite nicely, I mean, we do have all of our offices throughout the world, throughout Europe and whatnot. But from here on, we're just looking to certainly get South Africa sorted. And then we certainly will come out to our neighboring countries, places like Namibia, Zimbabwe, Kenya. We do obviously have quite a few traders from those various countries as well. Are there any more questions, guys? Is there anything that you want me to go over again with regard to the Fibonacci's? Are you all happy with how to put those things onto your charting?